Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going on there? It's October 25th. My friend Curzio, it's Wall Street Unplugged. So I break the headlines and... Tell you what's really moving these markets. So every year I go to this fair, my house, it's held annually in Callahan, Florida. It used to be called the Callahan Fair. They just changed it. It's called the Northeast Florida Fair. One of those fairs where it's in a really big field. They have all the rides, bunch of games. Not like the typical one that you might see, like a bazaar. Like much, much bigger than that, right? Got animals all over the place. All kinds of food, such as peppers, hamburgers, hot dogs, pizza, barbecue. Of course, you have the funnel cakes and the fried Oreos, which are amazing. If I had to bet, each one you eat probably takes a week off of your life. Most people say it's worth it. So I've been going to this thing for a while. Been in Florida for about 13 years now, 14 years. So I'd say at least 10 years. I take the kids, you buy these bands so they can go on all the rides. And there's usually, there's a lot of rides there. The place was always crowded. I used to take videos of it being like, I guess no one's worried about the economy. And that's this year, it was a very different story. Not only were there hardly any people there, just the quality of everything and the prices they were charging, it was insane. I mean, it got to the point where you were like, no effing way. So the games that you play, the darts, the basketball, I remember they used to be $2, they used to be $3, they used to be $5. I remember they used to be 50 cents. The minimum was $10. And for basketball, you have to get two in this hoop where, the hoop's longer than 10 feet and there's wind and you have these rims that are really small or they're usually bent so you can't get them in. Like nobody hit one shot. You had to hit two. And then you'd get, I think, 5 balls for $20, but the minimum was $10. $10 to play a game. One game that's going to be over in a second that you're not going to win. Hardly anyone's walking around with these big things. Sometimes you see a few people, but, rare. Now, the rides, each ticket for the ride used to be 50 cents. It was $2 per ticket, and you need at least 3. The best rides require 4 tickets. So you're looking at $6 to $8 for each ride. Or you could buy a band, which is $30 for unlimited rides. And then we got up there, because we took kids with us, and I always pay for the kids, whoever's with us and their friends and stuff like that. So you use your credit card. And to buy these bands, they would charge you a $5 fee if you use your credit card. $5 fee. They also charge you a $3 fee if you use your credit card to purchase food. So we had cash on us, and we avoided that, but $5 fee. I don't even know if that's legal or not. Even if you bought a drink, just a drink for whatever, the costs are extremely high. Some places in the fair you can get it for a little bit cheaper. They would charge you $3 if you use your credit card on top of that for the fee. But even speaking of drinks, literally a cup of soda, was $5. But you can get a souvenir plastic cup, and that's for $10. And when you get that, you get to refill it because you're special. You get to refill it for $5 refill for soda, which cost them what? 30 cents? 20 cents? So if you calculate this and you look at a family of 5, you're looking at $250 just for the food and to go on some rides. Didn't include any games, didn't even include dessert, didn't even include anything. No funnel cakes, they were like $11, $10 each. But it's the first time I've seen this. First time where the event was not crowded. It was probably because how expensive it was. More importantly, the quality of everything has gone down. It's gone down significantly. And there were rides that weren't properly working. The electricity went out in 25% of the park. They had a hand push a ride all the way down. And it was out for a half an hour. So some of these things had to be shut down. You have these little haunted houses that you go in. Went in, the lights weren't even on. Nothing was working. Another one where that round thing that you get in, that you step in and you can hold the sides, that wasn't working. Like when you first go in, that round thing that you have to balance yourself with your feet and everything. A lot of stuff wasn't working. The people working there, I think the qualifications include that you have to have a tattoo on your neck. And it's always been sketchy people at these events, but it was much worse now. And I'm not, I'm not being what to say this. But just, I don't care how you look. I really don't. But when you're wearing your jeans down, your underwear showing, and I'm bringing my daughters there and there's kids there, and you just, you could tell, like, I'm taking a break, and they'll come back. I mean, it's just the quality. I don't know where they got these guys. I don't know if they wait outside of jail or someone, as soon as someone's released serving time, they're like, hey, you want a job? I mean, probably a good strategy, right? They're going to be looking for jobs, and everybody hires them, ex-convicts or whatever, but it looked like that. It was bad. Like, the people yelling for the games, saying, they always try to get you over to play the games. It was scary, these people that were yelling at my daughters. I mean, hey, you want to play? I mean, it was like, whoa. It was like, But the quality just went down tremendously, and the prices went up enormously. The food wasn't really that good. I was charged close to $50 for 2 sausage and pepper sandwiches, a slice of pizza, and 3 drinks. $50. But the vibe felt different. Again, the quality, terrible, price were insane, and not a lot of people at this thing. This is one fair that I'm talking about, right? So it could be a one-off. But I visited, and this is the past week, a Home Depot recently, a Lowe's, some of the restaurants that we go to. The Home Depot and Lowe's were completely empty. There was nobody online at all. Nobody online at all. Went there about 7:30 p.m., but I've never seen them that empty before. Restaurants not as busy, some on Friday and Saturday, but others not as busy. And all the places, the prices are still being raised. And also, what are you seeing? You're seeing few workers around. I mean, yesterday was my wife's birthday, and she's like, let's just go to Olive Garden. We'll hang out there with the kids and stuff like that. And we went there, and it was a little crowded. Again, middle of the week. And there was one girl working 5 tables. So we finished eating. And if you ever eat at Olive Garden, they give you such big portions, you take a lot of it home. We said, can we get some boxes? It was my wife's birthday. We're like, okay, they're going to come out with a dessert and sing happy birthday. We waited about 20, 25 minutes. Sitting there after we ate. Now, keep in mind, my kids have school, they have homework, and we're going to go home and have a cake with my wife. But, my kids like sing the happy birthday in a restaurant and stuff like that. It took 20, 25 minutes to get boxes in the check. And I felt bad for this girl. And then all of a sudden they came out. They were like, oh, we're going to sing happy birthday. My wife's like, forget it. We got to go. And I felt terrible. It wasn't the girls' fault. There was nobody there working. I mean, it's not like you're waiting at 15 minutes and maybe you get your drinks and then they take your order and stuff like that. Imagine finishing and you're like, ready to get out there. And 20, 25, you're just waiting there. And I'm like, whoa, we were looking to get out. I almost just threw money on the table and walked out. And look, we've been talking. Everyone talks about it. Andrew Horowitz is going to get back in this podcast. We always say this all the time. Talk about a pullback in consumer spending, possible recession for years and years, right? Back in 2011, GDP fell below 1%, stayed under 2% for 3 straight quarters. Recession's coming. Consumers going to slow down. Never happened. 2016, 3 straight quarters of below 2% GDP growth. Seen a slowdown now. Didn't happen. 2019, I really believe this. In the end of 2019, earnings were not growing year over year. China was starting to die pre-COVID. I think we would have hit a recession without COVID. We thought that was going to happen. And then, we didn't get a recession there, but we did get a recession from COVID, which is like a black swan event. Different. And it was quick. But we've been talking about this with so many consumers going to stop spending. And then we realized the consumer never, ever stops spending. Ever, ever, ever. This never happens. Right? This consumer spending slowdown. It just doesn't happen. Even retail sales were pretty good last month. It's not happening. Continue to raise rates. But this is how we've been conditioned in this new market. For what? For 15 years. Low interest rates. Government spending. But is that about to change? Because if you look back at past recessions, they occur around every 6 years on a historical basis. Again, I'm not including COVID because it's a black swan event. It's not like, happened and it was a month and a half and then all the spending came in and again, lockdowns and stuff like that. But a real recession, right, caused by just, It happens with businesses. Things go great. You start putting more money into growth. Some of the things don't work out, and then you contract. Right? It happens throughout we've seen it happen sector after sector, every single sector. That's what cyclicals is supposed to be about. That's what a cyclical company is, right? Does well when the economy does well. What has a cyclical company? They do well forever and ever. They become secular companies because the economy is doing well all the time. Now, we really haven't seen a real recession in what? Since 2008, 2009? But if you look back, they're caused by the same factors. Rising interest rates used to combat inflation. This was 1980, 1982. We all know the story. The Fed doesn't want to make that mistake again. Stop raising rates and then lowering them. Oh, my God, inflation came back, right? We're not going to make that mistake again. Higher energy prices. That was the case in 1990. This is when Iraq, this invasion of Kuwait, also had high rates then, which led to the savings and loan crisis a year earlier. And the other thing is a massive expansion of credit or leverage, which led to the dot-com crash. Also, 2008, 2009 financial crisis at a much, much worse expense. Put it on steroids, the amount of leverage in 2008, 2009. .com, you had that leverage, but you had these valuations going through the roof and super expensive stocks, arguably the most expensive that we've ever been. Just before the .com crash. But massive expansion of credit. So these are the factors that cause recession. No surprise there. We all know them. Every economist talks about them, monitors them. But I feel like a lot of economists are asleep at the wheel here. And I don't really blame them. And why is that? Because they've been conditioned differently since the credit crisis, which was a long time ago, 15 years ago, almost 15 years ago. Because during this period, which never really happens, we added actually two X factors, right? That's excessive government spending along with super low interest rates, right? Favorable Fed policy. We never really had that for this long of a stretch. Because usually when you have those conditions, it usually leads to inflation a lot quicker. And both of these major factors in terms of the major drivers of economic growth, since 2008, and they result in our economy just doing fantastic and growing, consumer spending, growing all the time. And then what happened? We had the credit crisis, and we lowered rates to zero. The government also bailed out certain entities, backstop major banks, home lenders like Fannie and Freddie, insurers like AIG. They never did that before. Taking stakes directly in companies. But that money went to the companies, and they decide, especially the banks, they decide who they're lending to. You didn't really see inflation. So now you have a Fed that's saying, hey, man, let's keep rates low. If you listen to the commentary in 2010, 2011, rates are supposed to go much, 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 much higher over the next couple of years. But since we didn't have inflation, they didn't need to. So all this money filter into the economy. They kept it going. And they were supposed to raise rates once the economy found a bottom, which it did what? 2010 and 2011? But instead, they kept those rates at zero for almost 15 years. Then, look at post-COVID. Our government decided to inject money directly into our pockets. Not just talking tax incentives, which they use for these industries to grow EVs, alternative energy infrastructure, things like that, but by handing checks directly to consumers, directly to businesses, bypassing the economy. And they really believed this wasn't going to cause recession. They're like, we haven't seen recession in 15 years. How's this going to cause recession? There's no way this is going to cause recession. Or there's no way it's going to cause inflation, right? Or a recession. And the inflation started to take off. It's just massive inflation. And now what are you going to do? Because when you look at this conditioning and how we've been conditioned, and it's a very big deal. Conditioning is a big deal. And think about if you were around September 11th. When that happened, the next couple of weeks, and they grounded all the flights, I remember looking up if there was a plane that it was going to crash into something. because we just saw something that we've never seen in history. And as crazy as that sounds now, that's the emotions. That's how you feel. So you get used to certain and then, okay, you ease up and, okay, it's safe now. Well, you're conditioned a certain way, like this isn't going to happen. You're fine. It results in you changing. And you stop looking at things historically. And you're just like, wow, okay, this is the way it's going to be. If you look at Powell, who's a very, very smart guy, I don't care if you hate him, of course, people, you destroy him and you're going to get credit. Everybody destroys this freaking guy. Right? Someone's got to be at the helm at the Fed, and that guy's going to get destroyed by everyone because everyone's supposed to be smarter than that guy. They know so much more than that guy. But 18 months ago, this is a guy that looked you right in the eye. And he told you inflation was going to be transitory, and he meant it. He wasn't BSing you. Meaning that inflation can't be sustained because higher prices usually leads to slower demand. So inflation almost cures itself, right? It has a way of correcting itself. And he said it's going to be transitory. It's going to be transitory. We haven't seen inflation in a while, but it's going to be transitory. And then what did he do? And when you're wrong on something, you're wrong on something. That's fine. You could be a little wrong. You couldn't have been more wrong than Powell saying it's going to be transitory to raising rates by the fastest pace in the Fed era. You can't be more wrong than that. You literally can't be more wrong than that. You can't. That's like nothing's going to happen and the world ends. That's how far off he was. So what did he do? Immediately started raising rates aggressively to the point where he still wants to raise rates today. Even though if you look at the metrics, we're seeing a meaningful slowdown in the economy. You can say, okay, we know the story now. Transitory to never-ending rate hikes. Powell's a loser, doesn't know anything. Where are we today? Well, he wants to raise rates, continue, still see strength in the markets. Well, let's take a look at today, and let's look at the economy. Because when I told you the factors that cause recession, there was one here and one there. But every factor that caused a past recession dating back to the 1800s, every single one of them exists right now. We have high inflation. We have a Fed that's raised rates significantly, right? Fast pace in the Fed era, and is still looking to raise. We have rising energy prices. Again, these are the factors that cause past recessions. One, some, two, we have every one of those factors. And when we look under the hood, I mean, it's almost like a bunch of gang members moving into your neighborhood, and every one of them has a history of killing people. And you look at them going, hey, we're going to be fine. We're going to be okay. It's cool. Nothing's going to happen. And then you're like, we don't need police in this neighborhood. We're fine. That's what it's like in the economy. Because when I look under the hood, the warning signs are clearly there. Bank credit is contracting. It's only the second time this number has been negative year over year, dating back to 1971. The only other time was during the credit crisis. We have an inverted yield curve, which preceded every major recession dating back to World War II. Delinquency rates on credit cards are the highest they've been dating back to 1991. That's when they've been tracking this data. What about auto loan delinquencies? Hit their highest level in nearly 30 years. I don't even know what's going on with mortgage demand. It's a little slow. Going at the slowest pace since 1995. That's a long time. Housing is a massive driver of the economy. And it's at a standstill with mortgage rates near 8%, more than double where they were just 18 months ago. We were trying to explain why the home builders are such a great buy right now. There's supply issues. So, but you're looking at the housing market. I mean, these conditions that exist today, if you would have told anyone who's just a little bit smart, that knows what they're doing, that we would have, think of a year ago where we were. And the market was coming down. If you would have told me we were going to go up and the NASDAQ was going to see its biggest gain it's seen practically its history over the first 5 months of the year, based on massive increase in interest rates, based on mortgage rates, almost a shutdown of the housing market, demand so slow, delinquency rates through the roof, credit tightening, you would have said, okay, the market's going to be down a lot. But it's not. It's not. And why is that? Is because of that government spending. Those X factors. But the conditioning here, it still exists, where Powell and company want to continue to raise rates because they see an economy that's healthy right now. And what is this based on? Unemployment, still historically low. Factory production is still solid. Retail spending was strong last month. All this stuff's going to reverse. That's what happens when you raise rates a little. And that's not what we did here. We raised rates by over 6,000% from its lows. You're going to see unemployment move sharply higher from here. Why? Companies are about to see their fourth straight quarter of earnings declines, which was not on the table. It was 2 quarters and 3 quarters. Now it's 4 quarters. And notice this earnings season, we're supposed to see huge growth in the fourth quarter and then massive growth in 2024. Just like 3 quarters ago and 2 quarters ago, we were going to see this growth now, but it keeps getting pushing further out. Third quarter, Fed's going to lower rates. Got nothing to worry about. Earnings are going to start surging. It's a reason to go buy stocks. Remember, that was a bullish thesis. But now companies are going to see a 4th straight quarter of earnings declines, and next quarter, they're supposed to go up 6% on average. That's going to come down. And worse, that 6% is going to come from 2 sectors, which is banking and oil, which are the 2 worst sectors you want to see growing if you're a consumer and if you want to buy stocks. Why? Because it's high interest rates that are driving the net interest margin higher. It's why the banks reported $105 billion in revenue and $30 billion plus in profits, the 4 largest banks. I'm not kidding. That's what they generated. But they're worried. Jamie Dimon's really worried. What the hell are you worried about? You're generating record profits. Things are great for you. As long as rates stay high, they're going to be great for you. And then oil. If oil companies generate more profits, I mean oil prices are going higher. So higher interest rates and higher oil prices, things that cause recessions, those are the reasons why we're going to see earnings be pretty sure. That's where the most growth is going to come from. Again, that unemployment rate, it's going to move sharply higher. Retail spending was strong, but how long can that continue? With credit card rates above 20%, and now 40 million Americans are going to have to start paying their student loan bills again, which amounts to $400 a month on average for 40 million Americans. So we should now up to 65% of people say we live paycheck to paycheck in the United States of families. Also, when you look at the sales, it's not because they're buying more stuff, which is unit sales. They're paying higher prices, which is driving up prices, that's why you're saying, well, if I bought the same amount of goods that I bought last year, retail spending is going to be up. It's going to be up their inflation rate, which is 4%. And it was 7 or 8%. So retail sales are strong. They're growing strong. Are they really? Or is it just we're forced to pay higher prices? So when I see Powell go on TV right now and talk about things of a soft landing, which is going to be impossible to achieve, we're not going to have a soft landing. You're not going to immediately get rid of, high rates and just be like, okay, they're gone. Poof. You see how long it takes, 18 months, to filter through the system, and we're still not seeing the slowdown he thought we would see to get us down to 2% CPI. So reverse that. When they start cutting, because we haven't really seen the pause yet. They're still saying they're going to raise most likely. But when they start cutting, there's a reason why when you cut rates during these hiking cycles, usually you're raising rates because the economy's strong. Stocks usually perform well. When you're cutting, that's when stocks come down a ton. They come down tremendously because they're only going to cut if the economy is seeing a significant slowdown. So it can't be a soft landing. So for Powell right now to say, hey, you know what? We need to continue to raise rates because we have data like unemployment, wage growth still high. It's insane. It's insane to me. It's insane. Higher rates is going to result in higher unemployment. It will result in wages coming down. It's going to result in much, much, much slower growth, which we're seeing in housing. We're starting to see in travel. We're starting to see at parks like Disney and Universal, which we thought were untouchable. They're always going to see high demand. That's what I thought. That was a catalyst for Disney. Now you've seen a slowdown in parks. That's why they're trying to raise prices again. Let's see if they're able to do that and pass that through without hurting demand. But the slowdown is real. It's not going away like we saw in the past. Consumers are closing their wallets, and the growth catalysts we've seen over the past 15 years no longer exist. Like low rates, massive government spending. They can't do this anymore. $33 trillion in debt and $1 trillion in interest payments. How are they going to do this? They can't. You see what's going on with the House and the Republicans or whatever, and regardless, you know how I feel about politics? They're all idiots. They don't give a shit about us. We all know that on both sides. But I can tell you, if Republicans do win, they're going to focus on cutting spending. Because everybody's worried about the massive government spending. And if they do that, what do you think is going to happen to the economy? Now you don't have this free money constantly hitting the system. And we had it for the first 6 months of the year. Through how many government programs, Inflation Reduction Act, all this stuff, CARES Act, all this, right? All hitting just another $1 trillion into the markets. Why deficit's going higher and higher? It's crazy. They decide to put more money into the market. What's going to happen? Inflation's going to surge again like we saw in the 80s. So they don't have that catalyst that's driven the markets for over a decade. Or low rates, and what has been the growth engine of the world for most of this time, for the past couple decades? China, which is in terrible shape right now. Horrible shape. Japan's on fire. China's terrible. So what does this mean? Well, first, let me get a word from our sponsor. We have a sponsor on our podcast, right? Who's Masterworks. So you're wondering how to diversify your portfolio in today's extremely volatile market. You can do so through Masterworks, which offers temporary art that's demonstrated strong appreciation for decades compared to stocks, real estate, almost any asset class. I know what you're thinking. Comes a fine art. Used to be only open to the rich and elite, but through Masterworks, anyone can now own a piece or buy a stake in some of the world's finest art through tokenization. Should be familiar with that term. You can trade this art on their platform, similar to how you trade a stock, where investors own a percentage. It's like if you own a percentage when you own a share of Microsoft or Apple. You get immediate access to personally invest in some of the greatest artists and their work by going to www.masterworks.com. There's a great educational experience for those looking to purchase art for the very first time. Again, www.masterworks.com. So what does all of this mean? All the negatives that I just told you. Before you run out and sell everything and go, oh my God, we're dead. The market's dead. It just means portfolio positioning is critical. It means that growth stocks, when we used to buy growth stocks that matter about the fundamentals that worked over a decade, probably not going to go, I won't say it won't work at all, but you're going to have those fundamentals to back it. You've seen SPACs get annihilated where their fundamentals are pretty strong right now, some of them, because they raised a lot of cash. Bitcoin is an option, which we've been pushing for a very, very long time. Now everybody likes Bitcoin because it's up, was it 34, 35,000? It makes sense as an alternative. Gold has been very painful, I know, but catch a little bit of a bid. Especially as inflation does come down, and it will come down. As long as the government doesn't continue to throw trillions into the market. But you have to be very, very careful in your stock selection. You need to follow people that know what they're doing, that have been through this environment, that understand this. Because all those books that you read on finance, I'm not talking about trading, which is there's 5 million books on trading. Everyone's an expert trader in the world. Buy here, sell here. It's very easy. I'm not talking about those. I'm talking about the fundamental books. Earnings drive stock prices. Really? Because we're going to be down 4 straight quarters. Year over year in earnings, and the market is up, 12, 13% this year? You could say, well, it's led by 7 to 10 technology stocks or whatever. It's driving the NASDAQ. And that's including the past 2 months, 2.5 months, where stocks have really been selling off, especially the Russell 2000. But overall, remember, earnings. No, it's not earnings. It's the government, and that's not there anymore. So you really have to throw out all the textbooks of the reasons of why you should buy stocks. Because you got punished buying Coca-Cola instead of Microsoft very early on when those valuations were really inflated. for the Amazons, for software companies, for cloud companies. You're told they're too expensive. Don't buy them. They don't have great balance sheets. Those things went up hundreds and hundreds and hundreds of percent over the 10 years. That's what happens when you have zero interest rates and money's for free. It's a different environment. This isn't something that's going to go away anytime soon, guys. I wish it would. I'm going to sell more newsletters if it does. But it's not. It's a different environment. We've been conditioned that, oh my God, we shut down COVID. It was, 5 weeks. The market fell 30% and bounced right back. 2008, 2009, the world was going to end. It was 9 months. Everything perfectly fine. Thank you, Mr. Government. Injecting money, low rates. We don't have those catalysts now. That makes it a very, very dangerous market. And where I'm seeing the most value is in small caps. I know it sounds crazy. Sector where the Russell, I think, has sold off 16% over the past 3 months and 7% in the past 30 days. But I'm not talking about buying the Russell 2000. There's a lot of crap in it. I'm talking about buying individual names that have been down 25% plus from their highs. Companies that already restructured their debt, have tons of liquidity, are seeing some growth in their businesses, have great management teams, and they're trading at stupidly cheap valuations. It's no surprise that these companies that fit that profile, this is where their insiders are buying hands over fist. Insiders. And I'm talking about 10% owners that are getting into a stock. I'm talking about the CEOs, the CFOs, the executives of the company that already have big positions in these stocks. Those are the names that are in our portfolio in Curzio Venture Opportunities right now. A lot of them fit that exact profile. Dirt cheap, restructured debt, plenty of liquidity. That's the stock that we just added to today's issue. That's why its largest shareholder is buying shares hand over fist. Because the stock is off 40%, and every reason why the stock is off 40%, because it didn't have liquidity, business wasn't doing that good, they no longer exist. All those reasons why this stock has sold off tremendously. It's a good name, $4 billion plus market cap. It's a good name. It's a name you probably heard of. It's a symbol you'll never figure out, though. It doesn't make sense for the company. That actually, it's so weird. It's so weird. It's like a Curzio research. If I had a symbol, it'd be XPLN. Like, you're like, what? Like, you never figure out for yourself. This is a company that's been around for a while. And now their largest shareholder, who owns 16%, is adding to the position. Also, it's why one of the most prestigious hedge fund activists just took a stake in this company. And this legend that runs this hedge fund, been around since 2001, 2002, he's invested, it's activist, he's invested in many companies within this industry and has an incredible track record. Too recently that he was able to sell to bigger companies within this industry. I'm not going to tell you the industry, otherwise you'll probably be able to figure out the person I'm talking about and also the stock. I don't want to give that away because people pay a lot of money for Curzio Venture Opportunities, but these are the stocks I'm seeing. These individual ideas, the ones that have disconnects, where you only have these disconnects when you have a crazy market like this. Where retail sales are up. The market looks fine. Everything looks great. And yet you're seeing everything. Almost all these measures that say we're going to be in a recession are happening right now. All the warning signals are there. Are we oversold? Yes. Can we see a little bit of a pop? Yes. We're not talking about trading here. We're looking at a market that's extremely, extremely dangerous. But when you have dangerous markets, sometimes you have forced selling. People are too leveraged. They get margin calls. They're getting out of stocks. And you're seeing these disconnects, the largest disconnects that I've seen in at least the past 10 years. So the names that I'm looking at, we're not looking for 100% returns on. And these are names that can move the needle for you. I mean, 3x, 5x, 10x gains. You know me for a long time, and I do not throw out those figures lightly. I'm very real with you. But some of these names are down 60, 70%, and the reason why they're down, they were preparing for this recession we're supposed to have for 18 months. They restructured their debt, they have liquidity, and they're trading at valuations that are insane right now. They're extremely cheap, and you have the smartest people in the company that know everything about the company. Okay, there's millions of reasons to sell. For insiders to sell, there's one reason for them to buy, and it's even stronger if that insider is a CEO, CFO that's already a large shareholder. These are the names that we're seeing. Not only that, some of these names are actually buying back their stock because they have strong balance sheets. That's the market you want to be in. You have to be able to switch strategies. You can't be like, growth. We're not in a growth market right now. I know it's fun when you're in a growth market. You can buy whatever the hell you want. Doesn't matter. You don't have to look at one number or one financial. You don't have to know what the company's doing. Growth. That's all I want to see. But it's a different market. Be prepared because it's very, very dangerous. And again, the gains that you can get by focusing on companies that disconnects that you're seeing right now don't happen often, but they're happening in small caps. So Dan, I'm going to talk more about small caps and share some individual ideas with you on our Wall Street Premium podcast. Also going to be recommending a new recommendation, which we do every single week. To learn more about our premium podcast, go to www.curzioresearch.com. Made it very affordable for everyone. Sharing ideas, have a whole portfolio there. Really cool stuff. This is where we'll break it down further and share some of the names that we are seeing that's just big disconnects. Again, I'm not telling you to buy all Russell. I'm not telling you to buy every stock. I'm even seeing some of these in large cap stocks. Most of the market is dangerous, but right now, this is where you find the best deals. Like, holy cow, I can't believe where this stock is trading deals. They're hard to find. They're not easy. Anyone could recommend any stock, YouTube channels, people who have 1 year of experience. You need to understand these types of market conditions, guys. It's dangerous. High interest rates are here. They're here to stay. You're going to see it in your portfolio. It's not going to be pretty. I'm not telling you the stocks we're going to recommend are going to go straight up. They're going to be volatile. So we're scaling into these positions, buying half positions, and then waiting through earnings season and stuff like that to scale in because we want to be in these names. And if you have a time horizon past 12 months, again, the gains that you could see from some of these names, we're not looking for 100% gains. It's a lot more. And it's just setting up really, really well. The same thing I told you when our crypto portfolio is getting its ass kicked. Okay, just like everybody else. And I said, we have the best names in crypto in our portfolio. The average position was up over 600%. I know, that's insane. I've never seen gains like that in my life. I'm glad a lot of you have. But a lot of those names were recommended got annihilated. And I said, this is the time. It's crazy. I know it's insane, but the ETFs are coming, which is going to result in trillions of more dollars pushing into the system. Tens of millions of people, Americans, are going to be able to own Bitcoin for the first time and have access to it. And very, very easily. We don't have to worry about a wallet and all this education and Coinbase and stuff like that. They're going to be able to buy it just very, very easily through their 401k now. And then you have the Bitcoin halving, which happens every 4 years. And if you look the 6 months before and the 6 months after, Bitcoin takes off. That's why we've been pounding the table, which is not easy to do, right? When you have losers in your portfolio, which everyone has. That was crypto. You're starting to see it move. You're going to see the same thing over the next 6, 12 months, maybe earlier for a lot of these names that are already discounting a recession. They're pricing it in. I see a little bit of risk, but massive upside. That risk reward is fantastic right now. So guys, that's it for me. Again, see you in a premium podcast tomorrow. I'll talk to you then. Take care.